Hi, and welcome to Westpac London's End of Day report for Tuesday, August the 23rd. Very positive start to the session. The positive reaction that we saw in equity markets in Asia to the Chinese factory PMI, which although below 50 wasn't as weak as some may have feared, it continued into Europe. We saw French and German markets up 3% or more in early trading. However, a range of surveys released covering various sectors in Europe did hit the market somewhat. We saw the ZEW survey of German analysts post very steep declines in both its current assessment of where the economy is at and the outlook for the economy, obviously related to equity market fallout, the sovereign debt crisis, concerns about global growth and so on. And also the weak German GDP number for the second quarter, that would have had something to do with it as well. We also had an advanced report on consumer confidence for Europe, Euroland, biggest fall in 10 years, in the 10 years of that survey that's been around. The same factors more or less probably worrying consumers. The other report we had from the PMIs for Europe showed a weaker factory sector, although the services PMI held up at fairly weak levels rather than falling further. The factory PMI actually dipped below 50 for the first time since the recession of 2009. So overall, the survey mix wasn't particularly flash, and that hurt European equity market sentiment. And then when the US market opened, it didn't open up particularly strongly. But then we had the release of weak new home sales figures, the third decline in a row, confirming yet again that housing is simply not participating in the US recovery. In fact, I'll give you a stat. The level of housing sale, of new home sales in America is running at just over 1/5 of what it was at the peak 5 or 6 years ago. That just gives you a feel for how weak the housing story is in the US, 1/5 of what it was. And it hasn't grown. It's actually fallen 25% further from the level it was running at when the recession supposedly ended in 2009. The problem with the US recovery is that housing is not part of it, and if housing ain't growing, you don't get the consumer spending related to the housing story, and these are factors that are really constraining the US economy. We also had a Richmond Fed factory survey. It fell very sharply, and that's backed up the message from the Philadelphia Fed survey and the New York Fed surveys last week, which were also very soft. The detail on shipments, orders and jobs was weaker, and that firms up our view that the factory ISM survey, which comes out on the 1st of September, probably will dip below 50 also for the first time since 2009. So we're getting a run of weak surveys all over the place. You'd think that and the weak housing numbers wouldn't have helped the market, but actually it did, because it's fueled expectations that the Fed will be more inclined to provide some stimulus to the economy via another round of quantitative easing. And of course, Ben Bernanke speaking on Friday, he may address that topic. Equity markets are hoping for a repeat of last year, as I said before, where equities, I think, rose something like 28% after Bernanke hinted at QE at the Jackson Hole speech that he gave a year ago. So the irony was, or the unusual situation was, that very weak data actually boosted equity markets on the basis that it improves the chances of quantitative easing. So that's where we stand at the moment. It's 6:15 in the evening in London. So I'll give you a quick run through of where markets are at. The Dow's now up 2.2%. The S&P measures up to 2.5%, and the Nasdaq's up just over 3%. Oh, one other factor boosting the US was the government put out a report saying that problem banks actually have declined. There's still hundreds and hundreds of them in America, but it was less than in the previous report. And that's the first time we've seen actually that list shortened. So that was a positive for the financial stocks in the US as well. Europe actually benefited a bit from the rally on Wall Street. So when Europe closed, we saw the FTSE up 2/3%, and the French and German markets both up by just over 1%, although financial stocks still closed lower in some of the European markets. So that positive sentiment on equity markets that's coming through at the moment is helping commodities. Crude oil, for example, is up 2% today on the WTI measure. That's despite figures which showed that the federal government had actually released some oil from its strategic reserve. That would normally put some downward pressure on prices, and it did initially, but the QE story and the idea that it promotes inflation has meant that commodities like oil have actually rallied. Although gold hasn't. Gold's down 1.5% today. It's at $1,863 an ounce at the moment. It did touch 1900, I think, at one stage in the Asian trading session. So maybe a bit of profit taking coming through there. You'd normally expect it to rise on talk of QE, given the inflation risks that are perceived to be associated with it. And copper prices, they're oh my God, here we are, up 1%. Copper prices are up 1% today. And the Aussie's just risen above 105 against the US dollar, trading more or less with an upward trend through most of the London session and into the New York session, with the positive sentiment in equity markets helping there too. Actually, tomorrow in Australia, we've got construction spending data coming out. These are quarterly figures which will help us refine our GDP forecasts for the second quarter. That comes out in the second week of September. And just keep an eye on Libya. All sorts of the days look very numbered for Gaddafi. That will have some implications for financial markets, of course, in terms of the oil price and so on. Although I think that's largely factored in now. I'll leave it there. So I'm off for the day. Great talking to you. See you tomorrow.